1980s was truly a golden era. It was a time when Japan was thriving like no other, surpassing even the United States in terms of GDP per capita, albeit briefly. Companies like Toyota and Sony dominated global markets, and salaries for new employees in their 20s exceeded 100 million yen. In fact, among the top 50 companies globally, a staggering 30 were Japanese. Can you imagine the level of success? But what happened to Japan since then? How did a country that seemed unstoppable for 30 years end up in such prolonged economic stagnation? Let's take a closer look and understand it together in simple terms. First, let's go back to Japan's heyday. Japan's success can be partially attributed to global events, particularly the oil shocks of the late 1970s, commonly known as the oil crisis. Our industries relied heavily on oil, so when oil prices skyrocketed, it caused inflation across the board. To counter this, the US government played its card by increasing the benchmark interest rate. When the benchmark interest rate rises, bank loan interest rates go up, discouraging borrowing and reducing money circulation. As a result, the value of money increases relative to goods, leading to lower inflation. This move by the US helped curb inflation, but it also had unintended consequences, such as the appreciation of the US dollar, making American products less competitive in global markets. Japan emerged as the biggest beneficiary because its currency, the yen, became relatively cheaper. Affordable and fuel-efficient Toyota cars dominated the US market, and Japanese electronic products filled American stores. With a reputation for quality craftsmanship, Japanese products became the preferred choice for American consumers. This situation must have been hard to swallow for the United States, considering its history with Japan just a few decades prior during World War II. So, what did the US do? They convened an unprecedented agreement at the Plaza Hotel in New York, aptly named the Plaza Accord. The agreement aimed to lower the value of the US dollar and raise the value of the Japanese yen. This was achieved by government intervention to adjust exchange rates, a departure from the natural fluctuations driven by market forces. While this helped rebalance trade, it had unintended consequences for Japan. Following the Plaza Accord, the yen's value soared. For example, if $1 was worth 240 yen in 1985, it suddenly became 120 yen after the accord. Imagine the impact. Japanese products, once affordable in the US, became more expensive. This shift in currency value led to a decline in Japanese exports, affecting the country's economy significantly. To counter the overvaluation of the yen, Japan implemented expansionary monetary policies, lowering interest rates and stimulating borrowing. However, the excess liquidity fueled speculative investments in stocks and real estate rather than productive ventures. This led to a bubble economy characterized by soaring asset prices divorced from underlying economic fundamentals. The bubble burst, causing a cascade of problems. Households and businesses, burdened with excessive debt, faced bankruptcy. Banks, heavily exposed to real estate loans, collapsed. Unemployment rose, and consumption plummeted. Japan entered a prolonged period of economic malaise known as the lost decades. Despite numerous attempts to revive the economy, such as Abenomics, Japan continues to grapple with the aftermath of its economic bubble. Aging demographics, declining birth rates, and a shrinking workforce exacerbate the challenges. The COVID-19 pandemic further dampened hopes of economic recovery, and even the highly anticipated 2021 Tokyo Olympics failed to deliver the expected economic boost. In conclusion, Japan's economic bubble serves as a cautionary tale of the pitfalls of rapid asset inflation and the challenges of navigating prolonged economic stagnation. It's a reminder that sustainable growth requires more than just financial engineering. It necessitates sound economic fundamentals and prudent policy decisions. Thank you for your attention.